Dear students, now we will discuss the third category of ratios, that is known as the activity or turnover ratios. These ratios are also known as the performance ratios. These ratios are calculated in order to measure the efficiency of the organization, whether the organization management is in position to use its resources in a most efficient way. These ratios measure the efficiency of asset management and measure the effectiveness with which an enterprise uses resources at its disposal. These show rotation of concerned item within an accounting period, and under this we calculate certain important turnover ratios. Dear students, the basic objective of calculation of these ratio is there, that whether the organization is in position to use its resources in a most optimum way, because we all know that resources are very costlier and it is very essential that these resources must be used in most optimum way. So in order to measure the efficiency of the management, whether the management and its workforce is in position to use all these resources in most effective manner, certain important ratios are calculated. Under this category, in our syllabus, we had the four important ratios. First, it is called the stock turnover or the inventory turnover ratio. Second, it is called the debtor turnover ratio and trade receivable ratios. Third, it is called the creditors turnover ratio or trade payable ratios. And last, it is working capital turnover ratio. Dear students, it is important to understand the meaning of the word turnover here. Turnover here generally used with the meaning sales, but here with reference to these individual ratios, we calculate this ratio and use the word in different options and variations. Turnover is known as in terms of the sales or cost of goods sold or cost of revenue from the operations. Basically, it is the cost of goods sold. Let's understand one by one all these ratios and their formula to calculate. First, it is the stock turnover ratio or the inventory turnover ratio. It is also called as stock turnover ratio. This ratio establishes a relationship between the cost of goods sold or the cost of revenue from operations during a particular period of time and with reference to the cost of average inventory. The formula to calculate this ratio is very simple. That is the cost of goods sold or revenue from operations divided by the average inventory. Now, how the cost of goods sold is calculated? Very simple formula is there, that we can calculate cost of goods sold or cost of revenue from operations in two simple steps. First way is to calculate cost of goods sold is opening stock plus net purchases. Net purchases here means total purchases minus purchase return plus direct expenses minus closing stock. Or second formula to calculate cost of goods sold or cost of revenue from operations is sales or total revenue from operations minus gross profit. From both the formulas, you would get the same answer, that is cost of goods sold or cost of revenue from operations. Then come to the verb cost of revenue from operation, that is cost of material consumed, net purchases of stock in trade, changes in the inventory of finished goods, work in progress, stock in trade plus direct expenses. Now, if you find out this formula, you would also have the same answer as we had calculated with reference to the first and second. Then, with reference to the average inventory here means very simple, opening stock plus closing stock divided by 2. Average inventory here means the stock, that is opening inventory, closing inventory divided by 2 will give you the result of average inventory stock or the average inventory. Now, in some of the questions, you would find not opening or closing inventory, only the word stock is given. If that is given, then you have to divide only with that amount, that is the stock, because average will be taken only when both the balances average will be calculated only when both the balances, that is the opening balance of stock or the closing balance, both are given. If both are not given, you just take the stock and calculate the ratio. So this way we will calculate the inventory turnover ratio. Again, the formula is cost of goods sold or cost of revenue from operations divided by average inventory, and we can calculate cost of goods sold or cost of revenue from operations in these two ways, that is cost of goods sold opening stock plus net purchases plus direct expenses minus closing stock, and then second way sales or revenue from operations minus gross profit, result is cost of goods sold, and average inventory, that is the opening inventory plus closing inventory divided by 2. Let's discuss the second ratio, debtors turnover ratio or trade receivables ratio. Dear students, as you know, debtors are the results of the credit sale. So here, instead of cost of goods sold or the cost of operations as we had taken with reference to the stock turnover ratio or inventory turnover ratio, the formula replaces here with net credit sales or net cost of revenue from operations divided by average trade receivables or average debtors. Net credit sales, we all know, total sales minus sales return or return inwards. Or if only word sales is given, return is not given, so that amount will be treated as the net credit sales. So if credit sales are given, directly you will take the credit sales. If credit sales is not given, total sales are given and sales return is not given, then the total sales will be taken as the credit sales. And this credit sales will be divided by the average trade or average debtors. Now, how this average trade or average debtor will be calculated? Very simple. Opening balance of trade receivables and the closing balance of trade receivables divided by 2. Now, receivables are taken before deducting any provision for doubtful debts. Provision for doubtful debts will not be subtracted. The gross amount of debtors or receivables will be taken. If details regarding cash and credit sales are not given, then all the sales are taken on the credit sales. If details regarding opening and closing values of trade receivables are not given, then closing trade receivables are used for calculation of this ratio, because average could not be calculated. Average will be calculated when both the opening as well as closing balance of the trade receivables or debtors is given. So this way we will calculate the debtors turnover ratio or trade receivables turnover ratio. Now the basic purpose of this ratio is, and what this ratio indicates how quickly cash is released from the trade receivables. Generally, higher is the ratio, more efficient is the management of the trade receivables, that the organization is in position to very quickly and timely calculate from its receivables or debtors. The next ratio is calculated creditors turnover ratio or trade payable turnover ratio. Dear students, again, as you know, that the creditors are the result of the net credit purchases. So the formula to calculate this ratio is very simple. Net credit purchases divided by the average creditors or average trade payables. It is just the same way as we had calculated the debtors turnover ratio. As debtors are the result of the credit sales, so we had taken the net credit sales divided by the average receivables. Likewise, the creditors payable ratio, that is also very simple. Trade payable or creditor turnover ratio, net credit purchases divided by the average creditors or average trade payables. Again, the net credit purchases means total purchases less purchase return or return outwards, and the cash purchases. We have to take only the credit purchases. Again, average trade receivables is the result of opening trade payables and the closing trade payable. Because here the word is written receivables, we have to take the payables as a reference to the creditors turnover ratio. So we will calculate this way: opening trade payables plus closing trade payables divided by 2. Again, the same notes will be applied here with reference to this, as we had learned with reference to the debtors turnover ratio. Like that, what we have to do, as I told you, calculation: if details regarding cash and credit purchases are not given, then all the purchases taken will be the credit purchases. If details regarding opening and closing values of trade payables are not given, then closing trade payables or the credits are used for calculation of this ratio. Average cannot be calculated. Average will be calculated when opening and closing, both payable or both balances are given. This ratio shows that number of times the trade payables are turned over in relation to credit purchases over a year. Again, this shows how quickly cash is paid to trade payables. Generally, lower the ratio indicates that more credits are available for a long period of time. So instead of this, you have to understand the formula for calculation of this ratio, that is the trade payable or creditor turnover ratio. The last ratio which we will calculate in this category, that is the working capital turnover ratio. It establishes the relationship between net working capital and revenue from operations, that is net sales, divided by the net working capital. Formula to calculate this is the working capital turnover ratio, revenue from operations or net sales divided by net working capital. Now, in some cases, we can also calculate this ratio. Instead of taking revenue from operations, then cost of revenue from the operations or cost of goods sold divided by net working capital. Now, net working capital here means current assets minus fictitious assets minus current liabilities, or the difference between the current assets and current liability is known as the net working capital. And the formula to calculate this is revenue from operations or net sales. And generally, if it is not given or if the figures are not given, then we have to take the cost of revenue from operations or cost of the goods sold. And how it is to be calculated, that we all know that from the total revenue, we have to deduct what? We have to deduct the very important figure, that is the sales. As I told you in calculation of the very first ratio, that is sales or revenue from operations minus gross profit, or opening stock plus net purchases plus direct expenses minus closing stock will give you the cost of goods sold or cost of revenue from operations. That is also used with reference to the calculation of this working capital turnover ratio, that is cost of goods sold or cost of operations divided by net working capital. And net working capital, we all know, that is the difference of current assets and current liabilities. This ratio is generally depicted with reference to the times. As I told you, this ratio indicates the number of times the working capital has been turned over in relation to the revenue from operations over a year. And conclusion is, higher the ratio indicates the most efficient use of the working capital. I will continue in my next video the last category of ratios, that is the profitability ratios.